Hello and welcome to Trading 5 Talents. In today's video, I want to cover a new feature on the weekly options list website. Now, if you've been following my channel, I recently did a 5-week review on this website regarding their puts list. So basically, it's a list of cash secured put ideas each week that you can sell for profit. And the developer recently came out with a calls list, and so last week was the first week that it went live, and so I want to do a review on how that went this past week. So the link is down in the description, as well as a link to the spreadsheet that I'll be using here. So let me show you how I was screening these call ideas on the list. So here's the calls list, and you can see that if I go to the last page, there's 2,766 items on here. Now, some of them have multiple strike prices per ticker. For ease of following this, I'm just going to take off some of these headers, and I'm going to enter the filter settings that are similar to what I entered with the put. So $5,000, premium of 25 or greater, 2% ROI, and no earnings. So I'm leaving the delta and the out of the money percentage as blank. And I'll let you know why in just a minute. All right, so here's a list that I'm working with, and then I'll filter them going for the top 10 and only one call selection per ticker symbol. All right, so here we are in the Google Sheet that's going to be tracking these different options throughout the week. And I left a link down in the description if you want to use this sheet for whatever reason. I just made it only to do these weekly reviews, but you can use them for your own use if you want to. So down here on the bottom left are all the filters that I just put in for the calls: $5,000 limit, greater than $25 premiums, greater than 2% ROI, and then no earnings. Again, leaving the delta and the out of the money percentage filters blank. So here are the top 10 that I chose. Some other things that I wanted to mention that I did filter for, or at least considered during my selection of these tickers. One, I didn't trade any volatility stocks or ETFs or ETNs. I didn't trade any inverse products, and I didn't trade anything to do with futures. So just leaving stocks in general and ETFs, they would be listed here. So TLRY was the first one. And so you have the suggested strike price to sell this covered call at. Now, if you remember what a covered call is you have to own 100 shares of the underlying ticker symbol, in this case TLRY. You own 100 shares, and then you sell a covered call at the $10 strike price. If that stock closes below this covered call strike price at expiration, then you keep your shares and you keep your premium. If, however, the ticker ends above the strike price of your call, then you have to sell your shares at the strike price, but you still keep your premium. So as you can see with TLRY, let me hide these just so it's a little bit easier to see. This call option of the $10 strike price, it was based on Friday's close of $8.56 with a premium of 66 cents. Now it opened, you can see it gapped down. Stock price gap down, which is why it's in red. It went down to $7.74. So if you were to open this position, you would buy the stock at $7.74, and then you would sell one call at $10. So you'd have to buy 100 shares, so $774, and then you sell one contract or one call at $10, and you should receive about a 28-cent premium. Now, what happened to the stock? You can see that it went up and then it came back down, and that's what's shown here in the spark line. It goes up and comes back down, and then the premium just decreased over the week, which you would expect a short premium to do, and it expires out of the money with a final ROI of 3.6%. Now, the ROI was calculated by taking the premium that you received divided by the capital that you had invested, which I'm assuming was the $7.74 per share. So 28 cents divided by 774 would give you the 3.6. And then was this call assigned? That is, did you have to sell the shares at your $10 strike price? And the answer is no, you didn't, because the strike price here was greater than the close price of the stock by expiration. So I didn't classify this as a winner or a loser, as I mentioned in my previous video when I was talking about the call list from Option Seller ROI. And that's because some traders like to keep their shares, and some traders want their shares to be called away. So I don't know exactly what type of trade that you're looking for, so I don't want to say it was a good trade or a bad trade, or if it was a winner or a loser. I'm just telling you what actually would have happened. Your shares would not have been called away. The call would not have been assigned to you. All right, so that's TLRY. Let's look at the rest of them. So ACB opened at 411, and you sold an out-of-the-money call at $5, and you were not assigned. CGC opened at 801, sold an out-of-the-money call at 11. Here at GRWG opens at 933 and sell an out-of-the-money call at 11. Here at KODK opens at 670, sell at $7. At BILI opens at 29.25, sell an out-of-the-money call at 31.50. CPNG opens at 1832, and then you sell an out-of-the-money call at 18.50. Here at BBBY opens at 22.38, and you sell an out-of-the-money call at $28. NIO opens at 20.68, sell an out-of-the-money call at 21.50, and at PDD you open at 44.95 and sell an out-of-the-money call at 49.50. So in each of these cases, all of the call strike prices that were suggested were all out-of-the-money calls, and so usually that's what people do. They sell an out-of-the-money call. But again, as we saw in the suggestions from Option Seller ROI, some of those were actually in the money call options. So if, for example, let's just start at TLRY. For example, it opens at $7.74. The stock is $7.74 on Monday morning, and you sell a $10 call strike price. That's an out-of-the-money call. If you sold a $7.50 or an $8 strike price, that would have been an at-the-money call. Probably the $8 would have been at the money call. If you would have sold the $7.50 or the $7 strike price, that would have been an in the money call. So some traders have different approaches to selling covered calls. In this case, all of the call selections were out of the money, and you can see all of them except for this one right here, which was NIO. They would have been not assigned. They all would have expired worthless. And you can see the ROIs are all pretty good, just around 2% or higher. And again, even though I set the filter at 2%, 2% is based on the close prices of last week, right? They open up differently. You can see 856 close on Friday, and it opens down 774. Closes 446 on Friday, but it opens down at 411 Monday. So because of these gap up and gap downs, it's going to affect the final ROI from what I initially set the filters at. In 9 out of 10 of these cases, you would have kept your shares. Again, for some people, that's a win. For others, that wouldn't be a win. And it depends on what you want to do. Do you want to keep on selling covered calls on this stock? If that's the case, then yes, you want to keep your shares. But if you want your money back in cash so you can put on another play, maybe a put or a different covered call suggestion, then no, that would not be ideal, because now you don't have your cash. It's tied up in this stock. So for whatever it's worth, 9 out of 10 expired worthless. Every single one of them would have been profitable, as they were all out of the money calls. So let's look at this one right here, this NIO, because this is the one that would have been assigned. So here's what would have happened. It opens at 2068, and you would have purchased that at 2068, I assume. All right, so that's $2,068 you would have invested to purchase 100 shares of NIO. You sell the 2150 call, and you get 63 cents in premium. All right, so let's put that in here, 63 cents in premium. But because the stock increased all the way up to 21.93 by market close on Friday, and that was above your 21.50 strike price, that means you had to sell your shares at 21.50. So you bought them at 20.68, but you have to sell them at 21.50. Okay, whoops, 63 cents. 63 cents plus you sold your shares at 21.50, but you bought them for, what was it, 20.68? I think it was. Yeah, 2068. So $1.45 is what you would have netted, right? So that's, and obviously per share. So $145 you would have made on this particular play if you entered NIO. You would have kept your premium, $63, and then you would have actually made money from the sale of the stock because you purchased at 2068 and then you sold them at 2150. So that would have been probably the most profitable trade, and that would have been a final ROI much higher than what you actually invested. So if we could calculate that, 2068, so 145 divided by 2068, what you invested, 7%. That would have been a 7% ROI play. Premium plus capital gains. So that would have been great. All right. So that is what happened with the calls of this week of 328. I am going to be doing a follow-up for next week as well on the call list, and we'll see what happens. But overall, it did very well for this week, and I'm very glad that the developer chose to do a covered calls list as well as a cash secured put list. So if you have any questions about covered calls, running the wheel strategy, or what I've shown in this video, then go ahead and leave a comment down below or catch me on Twitter at Trading5Talents. If you want to keep up to date with all of the reviews for this site as well as OptionSellerROI.com, then go ahead and click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.